Revealing my largest position in the portfolio. This position or this stock is about 13% of the overall portfolio. I still believe the stock's undervalued. I'm going to talk about it, talk about the moat, the competitive advantage, the valuations, and why I chose the stock versus Meta or Microsoft or other amazing high quality companies. So I really hope you enjoy it as always. And this stock is Amazon. Amazon is finally starting to play out, but I believe it's only getting started. I haven't trimmed the stock, I haven't sold the stock. In fact, I'm still looking for an opportunity to potentially add more to the company, especially around the 220 to the $230 range. Now, the main question I get on Amazon is why I chose Amazon. Why isn't it Meta? Because Meta is trading at 18 PE, it's cheap, I talk about it. Or why isn't it Microsoft? And I actually own both Microsoft and Meta. I think they're undervalued and I love those companies. Yet I chose Amazon as my largest position, mainly because of the moat and the competitive advantage. So I'm going to use Meta as an example. And again, nothing against the company. I like the company a lot. But if we try to ask ourselves, maybe how likely are people in general to still be spending a lot of time on Instagram in the next 10 to 15 years versus what they spend today, it's really hard to assess it in general. And so you could see how TikTok, for example, came out of nowhere and people all have TikTok accounts and use TikTok and all these things. TikTok did not destroy Meta, but it just came out of nowhere. Now, are we going to have another social media app that's going to come out of nowhere over the next 10 to 15 years? Or is it going to be some kind of an integration within AI or Gemini and ChatGPT and some kind of a social app or something around it that could potentially hurt or take market share from Meta? So that's much harder to determine than to determine if people are going to be shopping on Amazon over the next 10 to 15 years, because it's really hard to come in and compete with Amazon. I'm not saying it's easy to come in and compete with Meta or to create a social media app, but it's much easier, as an example, to create some kind of a social media network than to reinvent and then to, you could say, copy Amazon's supply chain game, which they pretty much locked it up, was about a 28% market share in deliveries in the United States. And they're about to overtake USPS as in terms of delivery parcels in the US. You need a lot of trucks, a lot of infrastructure, a lot of warehouses, a lot of people, a lot of logistics stuff and planes and connections. You need so many things to come in and try to compete with Amazon on the delivery speed. It's much easier to compete with Meta than Amazon. I'm not saying it's easy, but it's easier to compete with, say, with Meta than with something like Amazon. And if you look at what they've been investing in, it's mainly warehouse space. They have like 751 million in square footage space, and they keep investing in infrastructure and keep doing it. And that has helped them to introduce 30-minute delivery for groceries as essentials. And now they're competing with Walmart, they're competing with Costco and BJ's Wholesale Club, and companies that they were not really competing with before, because people like convenience. They like to go to Walmart, buy their stuff, and come home. Well, now they don't need to do that because Amazon delivers it in 30 minutes, as they're rolling it out globally. So if you're someone that wants to compete with Amazon, you're going to have to match that 30 minutes. In order to match it, you have to invest so much in infrastructure and warehouses and all kind of things for you to be able to have any chance at competing with Amazon. And if you want to compete with Amazon and you want to build all those warehouses, they're going to be labor heavy, capital heavy. You need a lot of people in those warehouses to do a lot of the work. So if you want to try to compete with Amazon, it's really hard because they also have a robotics business. The robotics business for Amazon is very sophisticated. It was all built in-house with years and years of experience and technology and capital. So you're going to have to build all of that if you want to be profitable in the e-commerce business or the delivery business to try to compete with Amazon. And you could see how the robotics business has massively lifted operating margins from like barely 1%. Now it's about 11.5%. And it's only going to get better over the next 10 to 15 years. So it's really, really hard to compete with Amazon anywhere in e-commerce or deliveries or anywhere that requires supply chain investments. Now you also have AWS with Amazon. The backlog is now $364 billion. And by the way, I'm using Fiscal.AI to come up with those charts. If you want to try it out, they give you 2 weeks of free access if you use my link in the description. But again, it's been growing really, really well. It accelerated from 17%, 20, 23, and 28%. Now, other companies also have their own business. Google Cloud has been growing really, really well. But if a new company or any other company wants to compete with Amazon and they want to be profitable in the cloud business, they're going to also have to compete in the chip business where Amazon has a massive, massive edge. And this is what the CEO himself said. He said, if our chip business was a standalone business and we sold chips to AWS and other third parties, we would be generating $50 billion in annual run rates. They'd be one of the biggest chip companies in the world. And all of this is within Amazon. So this is the best part about investing in Amazon, is if the CapEx fears they hit the group and let's say they don't want to spend on CapEx anymore or something within AI, or maybe we have political backlash and then they ban data centers in some states, which is already happening. Well, that's extremely bullish for Amazon because Amazon's cash from operations will still be here, but CapEx will go down. So free cash flow will go up and they can start maybe buying back the stock or doing something else with the free cash flow. So if the CapEx story ends, Amazon wins. If the CapEx story continues, Amazon wins as well because they have the Tranium chips, which the company is not getting a re-rating like anything related to semiconductors. I think it's still priced like an old retailer. So if CapEx continues, Amazon wins in Tranium. If CapEx stops growing and they just flattens out, Amazon will win in free cash flow expansion. So the moat here is very, very deep. Then you have other investments and other bets that are hard to replicate, like Amazon Leo, which is trying to compete with Starlink. You pretty much have Starlink and you have Amazon Leo. Well, Delta Airlines, as an example, has tapped into Amazon Leo for in-flight Wi-Fi, and they did not go with SpaceX. They said SpaceX is too expensive, and they're going with Amazon Leo. Amazon Leo currently has about 200 satellites in orbit, and they're trying to build a constellation of about 1,300 low Earth orbit satellites. So they're trying to expand this business, and once they have them over there, that could be another massive business for Amazon, not counting other businesses that they have. So all those things are really, really, really hard to replicate because they have the physical mode, they have the infrastructure, and those real estate kind of assets are my favorite because you can't just code them, you can't rebuild them, you can't create them in a week or in months or in a year. You need 10 to 20 years to have any chance at competing with Amazon. Now, what about CapEx? People complain about CapEx a lot. As the company is spending $131 billion on CapEx. CapEx has only been getting worse over the last 3 years. So this is a big problem. And I kind of agree with that. But if you look at what they're getting out of this CapEx, or you look at the growth in cash from operations, it has been absolutely mind-blowing. From 46 billion to 84 billion to 115 billion to 140 billion dollars in cash from operations. This is a massive, massive growth against the capex. So the company is growing cash from operations and they're growing capex to match it. Now the trick is that very few people talk about is that they can cut back this capex any time because the company, or even if they don't cut it, if they just maintain it, if they maintain it at 130 billion and the company keeps growing cash from operations at this rate, their free cash flow is going to be insane over the next 5 to 10 years because of all the investments in AWS and all the things that they're doing. But this $131 billion, guys, is not maintenance capex, so it's not recurring. Amazon does not need $131 billion in capex to maintain operations. The Amazon online store, which generates 64 billion, does not require 130 billion in capex. The physical store don't require 130 billion in capex, maybe 5, 10, 15 billion maximum. They don't require 130 billion. Third-party seller services doesn't even require, in my opinion, 5 or 6 billion in capex. Most of it is been created and third parties. So that's a beautiful, very profitable business model. Advertising doesn't require 130 billion in capex. Subscriptions don't require 130 billion. Audible and Prime and all of them. AWS requires the most amount of capex. I don't know exactly how much, But if I had to guess, I would guess under 30, 40 billion. But I'm pretty sure it's nowhere close to 130 billion in maintenance capex. So, in other words, this capex is not maintenance capex, most of it is gross capex. And if Amazon wants to cut the cash flow, the capex, I think they can cut 50 to 60%, and Amazon would still be here, the store would still be here, the physical stores would still be here, the advertising business would still be here. I mean, all those businesses, I'm sure they can run on 40 or 50 total capex or 60 billion. So they can boost the free cash flow overnight if they decide to do it. But the company is not focused on short term profitability, they're focused on winning and widening the moat for the long term. And this is what you want every company to do. You should want the company to invest for growth if they're seeing it at attractive rates versus paying a dividend or just doing buybacks. So if I look at the valuation of Amazon, it's trading at almost 15 times price to operating cash flow. I was making fun of the stock trading at 12 times, but it's still 15 times is still really, really low for such a company that's expected to grow operating cash flow 33%, 29%, 24%. So you're buying it less than 1 times price to operating cash flow growth. And I think this is really, really attractive. So this is why Amazon is my largest position. It was a combination of my own capital, but I also been buying from $150 over the years. I've been dollar cost averaging. So some of it also has to do with gains. But I love the stock. I feel very comfortable having it as my largest position. And if it does pull back to 220, 215, 200, to me, that would be an amazing time to dollar cost average up on the stock and then buy a little bit more of the company. And I still believe it's undervalued. And that's my opinion on Amazon. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.